Can you actually defer taxes using an irrevocable trust? Yes, you can, and here is exactly how it works. Money comes into the trust. This is your gross receipts. Now, under UPIA, which is the Uniform Principal and Income Act, the trustee or fiduciary has to manage the accounting in the books for the trust. Now, what specifically governs this, according to state statute and the IRS, is the trust documents and the fiduciary or trustee acting in good faith. So the trustee and the trustee powers actually decide how the income is taxed inside the trust under UPIA and under the IRS code. Now, the trustee decides that we have two buckets. Number one, we have our fiduciary accounting bucket. Number two, we have our principal and corpus bucket. Okay, let's say that out of $1 million, we decide that we need to allocate $500,000 of our fiduciary accounting income into distributable net income. This is going to be taxable in two different ways, and I'll go over that. The second bucket is our principal or corpus bucket. We have $500,000 here, and this side of the house works just like an IRA. As long as you keep money reinvested into trust assets, it can stay tax deferred inside this little ecosystem. The key is you can't take a distribution, just like an IRA. It works the exact same way. Now, on a distributable net income, we have two different things we can do. Because the trust is a complex trust, meaning that it is not required to distribute funds, we can retain income inside the trust as retained D&I. Now, retained D&I is taxed at 37%, anything over $14,500. We also have our distributable net income that is actually distributed to beneficiaries. This will pass a K-1 to the beneficiary, and the beneficiary will be taxed in their respective tax bracket. Now, the trustee, for managing the trust, is going to need money. They need to get paid. So what happens? They get a 1099 for the trust for performing all of their fiduciary roles and responsibilities. And the trustee will use this for their food, fun, and fashion, their non-deductible trust expenses. However, the trustee can absolutely live in the properties that are owned by the trust in order to manage those. It can absolutely, for trust business, drive the vehicles that the trust owns. It can use trust assets. It can spend trust funds on legitimate trust expenses. All those legitimate trust expenses will be deducted for our fiduciary deductions, and everything else will be taxed. Now, that's how it works. It's really very simple. But it took our team of tax attorneys and CPAs decades to master this information. So you don't need to master it. You just need to let our team